That's carried. Thank you, Peter. That's great. Russell, do you want to come up and do your finance report, please?
Thanks very much, Mr. Chair, and good morning, councillors and Mr. Mayor. So this is the financial report for May. So at the high level, we've got a surplus as at the end of May of about $13.9 million, and we're forecasting a surplus at year end by $1.5 million. So what's driving the position? Well, to be honest, the messaging's been pretty consistent as the last few months, really. On the revenue side, higher interest revenues driven by the higher rate revenues. That's the growth component of the rate strike, higher than anticipated. Subvention receipts were higher, as was the trans waste dividend coming through. Also, rec and sport revenues have been higher than anticipated, and we've also had higher building consent volumes going through. The downside of that one, though, is we've had incurred higher costs going through to offset that a bit. So yes, so it's looking at the expenditure side, what's been moving. Debt servicing costs have been higher. Again, it's the offset of the extra revenue, but overall we're ahead of that, but still that's there. Three Waters, higher operating costs, and I'll come back to that again in a minute. And lower capitalisation of staff time, so that's staff putting their time to projects. That's been a bit lower than budgeted. A chunk of that has been more leave than anticipated being taken, a mixture of annual leave, people taking advantage of that availability, being able to travel and do things now, as well as there's been some leave without pay in there as well. And then the building consent, additional resourcing costs like I mentioned before. Savings within operating costs, strategic planning. So there's been a significant saving in there, about $1.3 million, mainly around vacancies in that space, and grants and levies at end of May. We hadn't dispersed all those, but that's forecast to come down by the end of the year. And Crown funding for the water transition was higher in May, but again, that's more timing. And come the end of the year, that will be more in line with budget. So, like I said, last month, we forecasted a forecast operating surplus of about $1.7 million. That's down slightly by 1.5. So there's a mixture of things in that space. In the Three Waters, there was significant movement in there, and a number of reasons. One was the revenues excess water billing. We had anticipated getting more revenues coming through there, but there had been a particularly wetter autumn than had been anticipated. So people were using less water. And improvements in transportation, recreation, sports, and regulatory compliance. There's ongoing work in both transportation and Three Waters and across the board, but particularly focusing on those areas, making sure that we have capitalised everything that we should. So we're looking through the OPEX costs, the maintenance costs, just to make sure that we've captured that well. And there's been some movement in there. So overall, that's why we're sitting at the 1.5. And I just made the point in like the report 4.2 there, when you're talking about an overall expenditure of just under $678 million, to have a forecast of 1.5 is whisper thin, but that's been consistently where we're sitting. So we're as confident as we can be that that'll be the year-end position. Just touching on capital, as Peter has said, we've got the capital guys behind me ready to do this. But just in an overall position, the forecast has been increased slightly. It was $390, now it's just under $405 million. So that's about $65 million lower than budget. That's offset significantly two main areas, Te Kaha, which is ahead of budget by almost $68 million, and Parakuri, which is below budget in timing by about $3.6 million. So overall, that's about a 1.6 in the total program. But like I say, the main reason for that is the additional and ahead of time costs in Te Kaha. And on the Treasury space, I just report that all risks within policy limits, and there's been no breaches as at the end of May or projected over for the next month. So happy to take any questions, Mr. Chair.
Thank you very much for that. It's always a useful update. Yanni.
Yeah, thank you. I was just interested in 6.7.2 on page 36, the lower reserve drawdowns, and you said mainly due to some development contributions unable to be drawn down at present and set aside to fund future works. I was just trying to kind of understand that. Just to kind of give you some background, a little bit more context to the question, one of the things I understand is that we can't build new reserves and growth areas because we don't have the funding, but we can't get the funding unless we've got the project on budget. So we get stuck in a kind of, chicken and egg situation. Are you able just to give us a little bit more understanding about 6.72? Or if not, can we get just some understanding of what that means?
I'm happy to answer as best as I can.
Cool.
Okay, so through you, Mr. Chair. So the development contributions are based on that. When we do a project, there'll be an increased level of service. Okay, so we've got to make the thing bigger or put more works in to cope for the growth of people coming through. And so the development contribution is a charge made to the developers for that anticipated extra infrastructure that we have to put in place. So that's so that money is used to fund that growth part of projects. Now, whether the project starts then or starts earlier and we have to borrow it in advance, or we've got the money to go ahead and do that, that's all relative timing. So what this comment is saying is that we've actually got the money sitting in our overall funding, but the work hasn't started. So we haven't drawn down the work. We haven't drawn down the funds to do that work. That's what that paragraph is identifying. Yeah.
Okay. And what's the risk that we have around that in regards to development agreements, consents? I mean, is it intersections that aren't going to get upgraded in Preston's, for example, because we haven't started the work, but we've got the money? Or
look, I'm not sure of the.
Yeah, it's okay to take that up. I mean, if it's something that the team could perhaps have a think about after the meeting, I wouldn't expect Russell to get down into the details.
I was just wondering if there's any sort of high level kind of risk around that fund not being expended. That was kind of
I think it might be something that's worth. Are you guys able to go and reflect on it and come back to Yanni? Yeah, cool. Thank you. Anyone else? Oh, Kelly. Yep.
Yeah, just thanks, Russell. I was just wondering if you could help me understand the little graph / table on 7.2 about which is on page 37.
Yes, certainly. So that's saying our overall borrowings, where that is. So the top line is the gross borrowings. So it's saying this time last year we had borrowed $2.1 billion. Currently we're sitting at $2.267 billion, and we're projecting will be slightly less than that end of June. The next line is advances to related parties, so that's mainly in the CCHL group. Okay. So we've borrowed and then on-lent the monies. That's what that's saying. So the last line is saying, okay, so what's the net position to Christchurch City Council? So that's what that is. It says last year we had $1.457 billion. Currently we're sitting at 1.3, and we're projecting to be 1.437 at year end. So overall, the red part in red on the far right, bottom right hand corner, is saying that our projected borrowings at year end is $20 million down on where we started the year.
Okay. For an organisation of our size, is that a where would that fit in the spectrum of in terms of borrowing? Is that considered high overall?
There's a number of factors in play. So what is high? So long as the funding can be serviced, then that's not high. And what are you using the funding for? So council uses it for capital projects that have long life. So our assets, in a commercial sense, you would use borrowing to fund assets that are going to produce revenue ongoing. So in a way we do, because we'll rate, but our capital works that we do, we bury most of them. And but they provide value for many years. So that's why we use borrowing as a mechanism to do that. As to are we high? Look, I'm not sure where we'd sit overall. We'd be in the top 3 borrowers if we're not the top 2 through the LGFA, where we get most of our funding from. Auckland, of course, outstrip everybody significantly. But we would be right up there, yeah. And also because, there was a lot of work done in the post-earthquake, a lot of capital expenditure spent to get things going as best as possible. And I understand, I wasn't here then, but prior to that, the debt was quite minimal. So, yeah.
So is there a plan to reduce that over time? I'm just looking at 7.4, the graph on 7.4, and just trying to understand that. So it looks like our borrowing requirements are going to step up in the next few years, but then be reduced in the subsequent years. Is that the effects of Te Kaha and Parakiore?
Through you, Mr. Chair, again. Yeah, that's significantly 24, 25, 26. That's Te Kaha sitting in there at that time. When we set the long-term plan, that graph will be changed again as to what we're going to what council decides to spend and how that's going to be funded. So there'll be more grey lines. There'll be more clarity around that. So the way we manage our exposure to interest rate movements, and there's been quite a lot of recent times, is we go out or fix as much as we can going without overdoing it, and to maximise interest rates that we've got now without subjecting council to the fluctuations as much as possible. So that's why there's some of those green bits further out. We've put borrowings out and grab the rates at that time. Yeah.
So if we chose long term to look to pay down as much debt as possible, how long would it take us without selling any assets to achieve a much lower level of debt, say like a couple of 100 million or something like that? Would that take years and years given our current income?
Through you, Mr. Chair. It's an interesting discussion. So it depends on the level of rates that you want to set. I mean, that's pretty much our income level. Income comes through that. So if we want to repay down debt faster and we're not selling anything to do that, then pretty much rates is our revenue, if you can call it that, source to do that. So it depends on the level. I wouldn't be advising to do that too fast, because there's a reason that you use debt as a funding mechanism, a thing called intergenerational equity. So as you know, it's that the cost of having the asset, whatever it is paid for the people who are using it. And so we have the rule, I think it's 30 years as a repayment schedule. So that's anticipated the length of the time for the asset. So yeah.
Okay. Well, thanks for going into that for me.
Yeah.
Appreciate it.
But certainly that'll be a significant part of the discussion as we form the LTP. Yeah.
No, they're really, really good questions, Kelly. That's brilliant. Okay. So I'm happy to move that. Phil's happy to second it. Any discussion? All in favour? Against? That's carried. Thank you, Russell. It's always a really good report, and it'll be good to see where we get to at financial year end.
It will be. Thank you.
Thanks. Okay, Richard.